Thanks for joining us lunch. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Meera Dugal. Let's get you the headlines. The Nifty and the Sensex erase almost all the morning gains. HDFC and HDFC Bank along with Kotak Mahindra Bank lead the declines.
Bankers welcome RBI's revised circular on stressed assets, says it's included most of the concerns voiced on earlier norms. Inclusion of NBFCs under the new rules, a welcome move.
Jammu and Kashmir Bank shares decline after the removal of Chairman Parvez Ahmed. The Anti-Corruption Bureau conducted raids at the bank's headquarters and other premises on Saturday, report via agencies.
Reliance Power reports its biggest ever quarterly loss after writing off investments in solar and gas-based generating units. Reliance Infra is yet to put out its numbers.
All right, let's first start with a look at the markets. Darshan is here with us.
Yeah, good afternoon. As you pointed out, the Nifty Bank, led by the heavyweights, is seeing a lot of pressure. While the Nifty has managed to rebound from the lows of the day, no doubt it's also come off significantly from the heights of the day. The Nifty Bank continues to bleed currently. It's down almost 100 points. If you're looking at where money is moving, again, defensives is where you can see money. So take a look at the sectors which have managed to gain. IT, pharma, FMCG, these are the sectors in which, there seems to be a little bit of traction, but sell-off happens on the PSU banking side, on the oil side, on the bank side, on the small cap side. Interestingly, take a look at the counters which have fallen significantly in trade today, and these are the high beta, high debt counters. So Suzlon is down 20%, Reliance Power is down 15%, there's Reliance Infra, there is Jain Irrigation, there is Reliance Capital, Dish TV, Syntex, PC Jewelers, you name the company. The companies which have been noted to be high beta and been associated with debt, all of them are falling significantly. So no doubt the Nifty has been managed because of moves that are coming into the IT counters. Across the broader market, there seem to be pain, and the high beta counters are taking a thrashing today.
Darshan, thanks for that. The Reserve Bank of India has revised its stressed assets norms, giving banks till 30 days after default to begin the resolution process. The central bank has chosen to incentivize banks for taking the IBC route rather than make it mandatory like in the earlier case. But one of the most notable changes in the new circular is that it brings non-banking financial companies under its purview. Joining us to discuss this is Sunil Kanoria, Vice Chairman at SREI Infrastructure Finance. Mr. Kanoria, thank you so much for joining us. What have you made of the new circular, particularly that NBFC is being brought under its purview?
I think there's one big challenge in terms of the regulators and the market being able to understand and differentiate the business model between a bank and a non-bank. The circular is very good for the banking system. However, it is very important to understand that a non-bank has a completely different business model than a bank, and the structure is different. So you can't treat both of them in the same manner. And I think that is where the challenge will be. Maybe some of the NBFCs have a similar profile of the asset like a bank, and therefore there may be some overlap, especially because the non-bank is such a large category of companies. You have public sector non-banks, you have very large housing companies as non-banks or non-banks which are there, and then you have many other multiple non-banks into asset classes, equipment financing, vehicle financing, etc. So you can't put everyone in the same basket. And I think that's where the problem would be through this guideline. By including the NBFC sector into it, you will completely blur the model of a bank and a non-bank. And that, to my mind, in the long term would be detrimental to the economy and the development.
Mr. Kanoria, could you detail that comment a bit more? So, for instance, if you have to fall under the purview of this circular, what could be the problem? I know that the banks wanted NBFCs in because in certain cases where NBFCs have an exposure, it was felt that the NBFCs are blocking some of the resolutions, etc. So now it's a level field. What's the flip side to it?
See, when you talk about a level field, you have to have a level field on the liability side also. Today, the problem is in the last 7, 8, 10 years in the country, the regulation on the asset side of a non-bank and the bank has been completely blurred. So therefore, the asset side of a bank and the asset of a non-bank, the regulator is saying this is exactly has to be treated the same way. I'll give an example. Say, for example, a non-bank, the traditional non-bank, when we all started off, were a lease and hire purchase company. We were providing pieces of equipment or vehicles, etc., to customers, which was not being catered by the banking system. And that was a way of providing financing, whether it was lease or hire purchase. Unfortunately, in the mid-2000s, because of multiple tax issues, the lease and hire purchase companies virtually died away because there was VAT, there was service tax, there was interest tax, and they made the product unviable. So the industry moved into writing loans. As a result, what has happened is that the regulation started to basically blend the asset side of a non-bank with kind of a banking system. I'm not saying that some of the non-banks don't do similar work what the banks do. Where our challenge would be that if I have provided certain equipments or vehicles to customers, and which may be more than 5 crore rupees, especially in our construction equipment space, we have customers with 10, 15, 20 crores. If there's a problem, I take away my asset and go home. And I can recover my money out of it. I would not want to put it into a integrator program of the banking system where I will be a small player in this large customer. I will have no role to be able to play, will not be able to protect my asset. So it jeopardizes my entire business model. I think that's where it is important for the regulator to understand the differentiation between many of these companies and ensure that the regulation takes care of these issues.
So essentially you're saying, sir, that the problem is the fact that, if you're forced to sign these intercreditor agreements, then if you have even a small share of a large exposure, which has to be above 2,000 crore for this framework to be applicable, then you sort of get stuck in the broader resolution rather than just taking, say, your asset or whatever you have secured the loan against and moving on.
Absolutely.
Okay, but does it not give you a bit more sort of visibility in some of the larger, more complex accounts, if you're part of them, that there would be a slightly more holistic solution that would get worked out? You don't think that's a positive in any way?
See, in some cases, yes. Say, for example, even in the insolvency process, the law has brought out differentiation between the operational creditor and the financial creditor. In terms of liquidation, I can go and take my asset and go recover my money out of my assets. So there have been some provision which is allowed. Now for home buyers, there is an additional change which has been allowed. What my sense would be, it is important for the regulator to look at the non-bank, differentiate the non-bank into different buckets. We cannot anymore in the industry, in the economy, have entire non-banking sector clubbed into one because you have different animals into it itself with different business models. So there may be some NBFCs who have a similar business model of a bank. They're fine. This can benefit them because they become a part of the banking system in terms of resolving an asset. But in many cases, it may not be so. Therefore, our urge, in which we will be representing from our industry, is basically that please bring that differentiation, keeping in mind the business model of the company which is getting impacted.
All right, Mr. Kanoria, thanks for that quick view. Understand your concerns there. NBFCs being brought into the new framework. Well, banks are welcoming it, perhaps NBFCs not so much. The RBI's new stressed asset framework, meanwhile, has been received well by bankers, as we said. SBI Chairman Rajneesh Kumar says that the industry's concerns over the earlier norms have more or less been addressed. Let's listen in.
The spirit of the circular is either you dissolve or go to the legal process, but don't sit on the stressed asset NPA. What we have to understand also is stressed asset. It is something like in ICU. If you keep on dithering and don't decide, who is being damaged? Not only the corporate debtor, but the lenders themselves. And I think the speed of the decision making, what this circular or the guidelines encourage, everyone, all lenders should take it in the right spirit. And my experience is that if any stressed asset, if you decide early, then you can recover better. The more you delay, the more money you lose.
All right, we spoke about the fine print of those guidelines with Sunil Mehta of Punjab National Bank and L. Viswanathan of Cyril Amarchand Mangaldas. You can catch that conversation at 1:30.
Jammu and Kashmir Bank has replaced its chairman on the order of the state government. While it's not the first such occurrence at the state-owned lender, Shefali is standing by to take us through some of those details on this one.
Well, an announcement on Saturday, the bank put out a release saying that the state government has removed Mr. Parvez Ahmed, who was serving as the chairman and managing director, and in place of him, they've recommended appointing Mr. R.K. Chibber as the new CMD for a period of about 3 months, during which a new chairman would be decided upon. And there are also reports suggesting that after his removal, immediately raids were conducted at the premises of the bank, and there are allegations of corruption, nepotism, and also terror funding, money laundering, etc. A couple of allegations with regards to the ex-chairman and certain malpractices at the bank. So all that is being inquired upon. And so the management today morning, the new chairman, he had a con call with the analysts and various other stakeholders, and in that con call he said that the said action has been taken by the government mainly to check the complaints received with regards to the malpractices at the bank, and so they've decided to implement certain measures such as preventive vigilance, and they're also trying to strengthen the accountability mechanism. And in the con call, the management actually tried to camouflage this news of the raids being conducted and the chairman being replaced with the focus on improving profitability going forward. But obviously the main focus point was with regards to the chairman being replaced, and the management said that they would try to do their best going forward, and this entire event would not have any impact on the financials of the bank. So that was a key takeaway from the con call. And remember, this management being replaced in a very abrupt manner is something not new that has happened at J&K Bank. We've seen that in case of Mr. Hasib Drabu as well, which happened in Q2 of FY11, and now this has happened again. So a couple of analysts, they're actually building this kind of uncertainty with regards to change in their management, with regards to change in the management in their evaluation model. So that is something which is being factored upon. It's something that Kotak pointed out in their report today. And if you look at the financials that panned out under Mr. Parvez Ahmed, the bank has actually done pretty well. The loss turned around to profit. The NPAs have come down, and the provisioning coverage ratio was shored up immediately in 2 quarters after he took over in October 2016. So financials on the face of it don't look fishy at all, but certainly we need to keep an eye on all these allegations which have been made against the ex-chairman and the bank on the whole.
Shefali, thanks so much for that. After delaying results for a week, Reliance Power reported its fourth quarter numbers on the night of June 8th. The company posted a 3,500 crore loss that includes a one-time impairment for certain assets. But the numbers have also raised certain questions. Darshan Mehta is here to take us through those.
Yeah, so basically, first they had said that they will come out with numbers on the 29th, then they again delayed it. But first we'll go through the financials, what exactly happened with the financials of Reliance Power. Revenues were down 32%, EBITDA was down 35%, and a decline of 180 basis points as far as the operating margins were concerned. Now look at the loss of 3560 crores as against a profit of 188 crores last time around. So that is definitely there. But obviously this includes a bit of impairment that will come in. Now what had happened is on May 21st, Reliance Power said that the board meeting is on the 29th, and this is when they will declare numbers. Then they said that the board meeting has been shifted from the 29th to the 7th because certain board members were not available, and that is why. Even on 7th they did not declare. They finally declared numbers on the 8th, and that is when the numbers came in, and the shocker of the number came in. Now as far as the impairment was concerned, some other factors. First of all, other income was up at almost 102 crores. Despite having a tax credit, they were able to report a very weak set of numbers. But this is the concerning part. The finance cost of 1,000 crores is now more than the EBITDA of the company. So that is something that gives an indication that they're not able to actually fulfill their debt obligation. Now 4170 crores is the impairment that they've taken across 4 or 5 plants out of it, and they say that 1,000 crores was withdrawn from the general reserve. If this was not taken, the impairment cost would have been more than 5,000 crores. So that's the number. This is the breakup. 2 major plants, that's the standalone, that's the Reliance Power plant, as well as the Rajasthan Sun Technique Energy. They had impairments to the tune of 1,400 crores. They indicate that gas didn't come in from for their plant, so after 7 years they impaired it, and the technology for the Sun Rajasthan Technique Energy was not viable, and that is why they impaired it after 5 years. So clearly they themselves took an impairment after waiting for 5 and 7 years. That's the big question mark. Look at the balance sheet, how it's deteriorated. Cash from 2,500 crores is just 29 crores. Borrowings have gone actually more than doubled, and current liabilities have also gone up more than double. So that's the weakening balance sheet of Reliance Power. The other factor is what the auditor said. They're saying that the depreciation method is different from the Ind AS standard. Apart from it, they also spoke about that the 400 crore inter-deposit intercorporate deposits that they have done had not had any kind of prior approval, and audit of 39 subsidiaries were based on the other auditor reports. They themselves didn't do it. So they had actually raised questions on the going concern of 2 of their subsidiaries and the company itself. So that's a big concern, and that's why the counter is down in trade. The other point is Reliance Infrastructure, which is the parent. They themselves have actually delayed the result for the 4th time. Now they say that the results will come in on the 14th of this month due to consolidation of the Reliance Power results. So that is something that you need to watch out for. They own 33% stake in Reliance Power. So both Reliance Infra and Reliance Power, both of them are down in double digits today.
Roshan, thanks for that. CARE Ratings downgraded EROS International Media last week, prompting investors to turn wary of the stock. Meanwhile, parent EROS PLC has announced a share repurchase program. Sajid spoke to the company's chairman, Kishore Lulla, about the share repurchase and why the company wasn't using its cash on books to honor repayments. He started off by asking him why the share repurchase is not being done in India, where EROS International is listed.
Repurchase share program, which you saw the announcement, is at the PLC level at the New York Stock Exchange. And the promoter, EROS PLC, which owns the majority of EROS India, has creeped in the shares in the last quarter also, will keep on doing so for the Indian company in any event.
Okay, my question was that, we saw a sudden erosion on share value for the Indian shareholders there. Why didn't you come out with a buyback program for the EROS India?
No, you see, what we have done, we have bought the shares. EROS PLC has bought shares of EROS India in the last quarter, if you see the filings.
How much have you bought in? If you can give us some numbers or idea?
About 2%, up to 2% of the company.
Okay. And you plan to continue buying those shares in the market?
Yes, we plan to continue buying the shares.
Let me come to the CARE downgrade that happened. It was the case. Downgrade was for a small amount of $1 million or $2 million. Why did why couldn't the company pay off the principal and interest to banks?
It was some misfortunate error. Now that has been rectified, and we will take up with CARE now so that we can get our ratings reinstated in the coming weeks. And if you look at the company.
Yeah.
We have reduced our debt in the last 1 year of 100 crores, and there are no debt maturities in this year except some term loan installments, about 50 crores. So, and the cash flow of the company from there we can easily sustain.
That's what is surprising because, CARE in its rating reports very clearly stated that there's a slowdown in collection of money from debtors, and also, and this has been confirmed by the company and the banks from where they have taken a default, if any, statement. Also, they have gone ahead and said there is a cash flow issue with as far as EROS International Media is concerned.
See, there are, temporary cash flow issues sometimes from the delay, but there is no alarming situation as such. We have, as we said, in the last 1 year, reduced the debt by 100 crores, and there are no significant debt maturities. The point to note is there are no significant debt maturities in the company, except the term loan installments, which will be this year, which we are fully confident to service, and company is in a very good health.
No, I'm a little surprised when you say there are temporary cash flow issues because as far as the disclosures made by the company is concerned, you're sitting on 141 crores of cash and cash equivalents. So, a payment of $2 million would have been easily paid. And if you're saying that you had a temporary cash flow, then that's a surprising thing because of the cash you're sitting on.
No, cash has been sitting on in the subsidiaries, and if we bring those cash from the subsidiaries, there are dividend tax involved, and that's the reason we didn't had those. And the other cash which is sitting, it's in the cash equivalents with the banks only. So this is from the cash flow from the operations. We had some slowdown, but that's picking up. That's normal course of business. Sometimes the slowdown happens.
Okay. When I look at your balance sheet, I see that there is a receivable of nearly 800 crores which is coming in at the end of March 2019. What is the reason for this high and increasing receivables?
No, receivables, from the catalog syndication, we give the DSO days credit of anywhere from 250 to 300 days to the customers because of the catalog revenue. And that is the normal course of business whereby there are certain, so say suppose the theatrical cycle is anywhere up to 90 days. The catalog syndication, the cycle is anywhere from 250 to say 60 days.
Steel companies have managed to hike prices this month, but the most important raw material, that's iron ore, also got more expensive this month. Nikki Mirchandani standing by to put those numbers into perspective. Nikki, so the steel makers managed to pass on the higher costs?
Yes, they have on back of higher iron ore prices, but then the likelihood of whether these price hike would sustain going forward is something that we'd like to question. Right now, we're looking at a 2 to 3% kind of uptick seen in the prices that we've seen for the month of June. They are to the extent of $750 to $1,300 per ton, with the price hikes being higher for HRC and less than that of compared to flats. Now, NMDC, as you'd recollect, that the price hike was the highest that we've seen at least in 8 months on back of the depleting inventory level, and also the price hike followed suit of the regional players amidst the global background where the prices internationally too have been soaring on account of the production cuts that we've seen by these players internationally. This actually has made us ask now, if you look at the recent price hike, there is the Indian prices now trading at a premium as compared to the imported prices, which makes us believe that the steel players could now resort to incremental imports, which already have been a cause of concern for most of these players around. And also, if you look at the iron ore prices trend internationally, they have been correcting. In the month of June itself, we've seen a 1.5% kind of correction in SGX iron ore prices, which in turn could reflect on sour sentiment across domestically also. We spoke to Managing Director of JSW Steel. He believes that the iron ore prices are not expected to stay around the current level of around $95 to $100 per ton and are likely to correct in the range of around $75 to $80 in the second half of this financial year, which in turn could imply that given the kind of supply chain, this could be further passed down to steel prices as well. However, JSPL has a contra view on this. It suggests that they are expecting a 7 to 8% kind of uptick in the steel prices with the formation of stable government. But then when we spoke to the market advisor, Rakesh Arora to be precise, he said that he doesn't expect, he expects steel prices to remain range bound, if not correct at the best, destocking at dealer level in light of ongoing trade concerns and seasonally weak period for steel companies expected to stay stewed. Back to you guys.
Sure, Nikki, thank you for that. Mutual funds saw net inflows of almost 77,000 crore last month, but it was the equity mutual funds which saw higher inflow while all other segments saw a dip. Yash Upadhyay is standing by to take us through some of those monthly numbers.
So that's right, Harsha. So the total mutual fund industry flows, that stood at about 76,990 crore rupees, which was a drop on its over its previous month in April, where we saw flows in excess of 1 lakh crore rupees. Now, this was mainly driven on account of muted flows coming into the debt or income-oriented schemes, which stood at about 70,000 crore rupees versus 1,20,000 crores in the previous month, which is a 42% dip on a month-on-month basis. This was also primarily driven by the fact that several of the schemes, the short duration, medium duration, as well as the credit risk fund category, they saw significant amount of outflows in the month of May. On the other hand, the net inflows into the equity mutual fund schemes, that was a big positive. So this includes the equity as well as the ELSS side, and that number stood at about 5,400 crore rupees, which was a bump up on a month-on-month basis from 4,200 crores in the month of April, with both the mid-cap and the small-cap schemes seeing inflows in excess of 1,100 crore rupees for the month of May, which was a positive, and according to one of the industry experts that we spoke to, indicates a transition in the investor preference. Moving on, the overall mutual fund industry AUM, that crossed the 25 lakh crore mark for the very first time, which is a historic number for the industry. The SIP number, that came in a shade lower on a month-on-month basis, so about 8,183 crores is what the number stood at for the month of May, as compared to 8,238 crores inflows in the month of April. So all in all, the equity side did not disappoint. However, outflows from the debt-oriented schemes that resulted in the overall total mutual fund flows coming in slightly lower on a month-on-month basis.
All right, Yash, thanks so much for that. Corporate earnings showed some sign of improvement in the last quarter, but it's nowhere close to an all-round recovery. However, that's not prompted analysts to estimate better numbers for the current financial year. Somit Sarkar here with some details. Somit.
So I'll start off with the selection criteria first. So we have selected companies that have that have at least 10 analysts tracking the company, and we have excluded the companies that belong to the BFSI sector. So there are nearly 203 companies that fit this criteria, and among these 203 companies, 153 of them are expected to report a growth in their EBITDA margin. That is, nearly 70% of the companies are expected to see their EBITDA margin expand in FY20 compared to FY19. Starting off with the list of the top 5 companies that are expected to see the highest jump in their EBITDA margins. In the aviation space, we have Indigo and SpiceJet, which are expected to see a 789 basis points change in their EBITDA margin, while SpiceJet is expected to see a change of nearly more than 700 basis points in their EBITDA margin. That is because of higher ticket prices, capacity expansion, lower fuel cost, and also a low base in FY19. FY19, if you remember, both the companies were hit because of lower ticket prices and higher fuel cost, because of which the margins were lower in FY19. That's the reason we can see such a huge growth in both the aviation stocks. Second on the list is Vodafone Idea. Now that company's EBITDA margin is expected to expand by nearly 780 basis points, but that is largely because of the merger synergies. Now Vodafone India and Idea Cellular completed the merger on August 31st, so FY20 will be the first full year where the combined entity will realize the merger synergies, and that's the reason the EBITDA margin is expected to jump. Third on the list is fourth on the list is NTPC, where the company is expected to see an EBITDA margin jump of nearly 771 basis points, and that is because of a low base of FY19 coupled with operational efficiencies, reduction in fixed cost, under recoveries because of coal availability, and because of capacity addition. The company's EBITDA margin is expected to rise by nearly 700 basis points. Now on the list where the companies are expected to report the biggest drop in their EBITDA margin, JSW Energy is expected to see a drop of nearly 1,000 basis points when it comes to the EBITDA margin, and that is because of volatile prices of imported coal in India, lower spot realization, and because of depreciating rupee that the analysts are expecting its EBITDA margin to decline. Nalco, now that company is expected to report a decline of nearly 797 basis points in their EBITDA margin, and that is because of lower aluminium and alumina prices and because of a lower volume growth. NMDC's EBITDA margin is expected to decline by nearly 800 basis points, and that is because FY20 will see the first full year impact of the Donimalai plant shutdown. Along with that, lower iron ore prices because of higher availability and because of the iron ore mine auction. This EBITDA margin of NMDC is expected to decline. Now for KNR Construction in FY19, if you see, their EBITDA margins were higher because of completion of EPC projects and because of higher margin coming in from the irrigation projects. Now because of absence of these two factors in FY20 and higher commodity prices, the company's margins are expected to decline here. Bharti Infratel, now that company's margins are expected to decline largely because of lower tenancy ratio that is expected in FY20. Their margins are expected to decline by nearly 600 basis points here.
Somit, thanks for that. Out of time on the show. Thank you so much for joining us on lunch today.
Lots more coming up.